right, diving right in today, we're tackling a topic that's, well, it's fundamental to any investor, really. Economic cycles.
hmm
Those ebbs and flows that impact, well, everything from stock markets to real estate to, heck, even that crypto you might be hearing so much about these days. It's one of those things, you hear it everywhere, but, truly understanding how these cycles actually work, that can make a huge difference in how you approach your investments.
Absolutely. Yeah, it's easy to get caught up in the day-to-day, the market noise and all that, but taking that step back, understanding that broader economic context, that's where informed decision-making really begins. Seeing where we are in the cycle, what forces are driving it, all of that.
Okay, so for someone who maybe hasn't had a chance to really, I guess, delve into this, how would you even define an economic cycle? What are we really talking about here?
It's essentially, at its core, the natural rhythm of an economy. We call it the business cycle, too, which, that might be a more familiar term for some folks. But picture, like a wave-like pattern, right? With these distinct phases, expansion where things are booming, followed by a peak, then a contraction, which often, that's referred to as a recession, and finally you have the trough before the whole cycle begins anew.
And each of these phases, they bring about these like unique opportunities and challenges for investors, right?
Exactly. And that's really the key takeaway here. It's about aligning your investment strategy with these phases, not trying to fight them, Knowing where you are in that cycle, even just having a sense of where things might be headed, anticipating those shifts, that's what can give you a significant edge.
So let's break each phase down then, starting with expansion, the good times, everyone's favorite, right? But I imagine there's more to it than just, everything being rosy.
Oh, absolutely. It's not all sunshine and rainbows, even though it might feel like it at the time, for sure. During an expansion, you see, businesses are thriving, jobs are being created, wages are rising, and there's this overall optimism that just kind of drives the markets. But, and this is important, as that exuberance builds, it's really crucial to watch for any signs that, well, that things might be getting a little too hot.
What kind of signs should, like, set off alarm bells in your mind? What should people be watching out for?
Keep a close eye on inflation. When you see prices increasing too rapidly, that's often a signal that the economy might be overheating, and that can lead to a response from, central banks, the Federal Reserve, things like that. They often step in to try to control that inflation by raising interest rates, and that can impact everything, really. I mean, we're talking borrowing costs for businesses, mortgage rates for home buyers. It's all connected.
So it's about kind of recognizing maybe those subtle shifts in the economic winds, even when things seem good, even amidst all those, good times. Because that carefree expansion phase, well, it doesn't last forever, does it?
Unfortunately not. Eventually, we hit the peak of the cycle. Think of it as the economy reaching its high water mark, right?
Yeah.
Economic indicators, your GDP growth, employment, corporate profits. They're usually at their highest at this point, and this is key, this peak often masks underlying vulnerabilities.
So at the peak, even though I guess, like, the numbers might look great on the surface, there's a sense that maybe things are about to turn.
Precisely. It's like a game of musical chairs, right? That the
Right.
music's still playing, everyone's having a good time, but any minute now it could stop. And more often than not, the investors who recognize the signs of a peak, they start adjusting their strategies. Those are often the ones who navigate the coming downturn most effectively.
Okay, so let's talk about that downturn then, the contraction phase, or as it's more commonly known, a recession. What defines this phase, and how should investors be thinking about it when it hits?
A recession is essentially a period of, significant economic decline. We see businesses pulling back, consumer spending drops, unemployment starts to rise, and generally you just feel it in the markets. A more cautious, even pessimistic sentiment takes hold. It can be unsettling, especially, for newer investors who haven't, maybe lived through one of these cycles before.
It definitely sounds like a time when it would be tempting to just like hit the panic button, but I imagine that's the last thing you actually want to do, right?
Absolutely. Panic is never a good investment strategy. It's important to remember that recessions, they're a natural part of the economic cycle. They're not fun to go through, but they're also not unusual. Think of it more as, like a necessary correction, especially after a period of, maybe unsustainable growth. Things can't just go up forever, right?
Yeah. So it's about weathering the storm, so to speak. But how does one go about doing that effectively? What are some strategies investors can consider during a contraction?
Well, seasoned investors, they often view recessions as buying opportunities. Stock prices are generally lower, which means you have a chance to invest in, fundamentally sound companies at a discount. Think of it like it's like a clearance sale for your portfolio, right? You can stock up on quality investments while the prices are down.
I like the way you think.
Ugh.
But for those who are, a bit more risk averse, what are their options during a contraction? Surely there are ways to navigate this phase without, going all in on stocks.
Absolutely. This is where, a well-diversified portfolio really proves its worth. Remember those bonds we talked about earlier? They often become, well, more attractive during contractions, particularly government bonds. They're seen as very safe.
So kind of like a flight to safety, even if it might mean, potentially lower returns compared to stocks, right?
In a way, yeah, it's about balancing risk and potential reward during a contraction, sometimes preserving capital, just minimizing losses. That might be more important than chasing those high returns.
That makes sense. So we've talked about stocks, we've talked about bonds, but what about other asset classes? Are there any that, tend to do well or at least hold their value during these contractions?
Historically, gold has been seen as, well, kind of a safe haven asset during times of, economic uncertainty. Investors tend to flock to gold because it's considered a tangible asset. It's got that intrinsic value, something that kind of holds up when markets are feeling a little volatile.
So a bit of a hedge, I guess, against those economic storms. It's fascinating how different asset classes can react, well, so differently, depending on like where we are in that economic cycle.
It really does. It highlights why understanding these cycles, how they influence those different parts of the market. That's really key. Now, we've talked about expansion, the peak, and contraction, but no cycle is complete without that final phase, that trough.
The kind of like the bottom of the wave before it starts to build again, right? It sounds almost, I don't know, ominous when you put it like that.
It might sound a bit daunting, yeah, but it's actually a point of, well, it can be a point of real opportunity for investors. Think of it this way. The trough, it represents this point of like maximum pessimism. Fear and uncertainty are often at their peak, but, and here's the thing, so are the potential gains for those who are prepared.
So the calm before the storm, or maybe more accurately, the calm after the storm, what makes the trough such a, I guess, unique point in the cycle for those investors?
The trough really represents a turning point. It's the point at which, the economy, it's bottomed out. It's poised for that recovery. This is often when we see central banks, governments, they start stepping in with measures to try to stimulate growth again. Things like, lowering interest rates, injecting some liquidity into the financial system, maybe governments increasing spending on infrastructure projects, things like that.
So a little bit of a helping hand, I guess, to kind of get the economy back on its feet. But how do these actions actually translate into like tangible investment opportunities? How should people be thinking about this?
Well, take lower interest rates, for example. When rates are lower, that means it's cheaper for businesses to borrow money, right? And that in turn encourages investment expansion, which then can lead to job creation, more consumer spending, and ultimately a broader economic recovery. For investors, it's a chance to get in on the, I guess you could say the ground floor, so to speak, before that recovery really starts to gain momentum.
So instead of fearing the trough, kind of like we talked about with recessions, savvy investors, they see it as the starting line for the next phase of growth, for the next bull market.
Precisely. It's all about recognizing that the economic cycle is, well, it's just that. It's a cycle. It's continuous. Each phase flows into the next. And just as the peak presents opportunities for those who are prepared, so too does the trough.
So we've explored these four distinct phases: expansion, peak, contraction, and trough. But how can our listeners practically apply this knowledge? How can they use it to make more informed investment decisions? It's all well and good to, understand the theory and all that, but how do we actually put it into practice?
That's the million-dollar question, isn't it? And while there's no magic formula or anything, understanding these cycles, it can significantly, enhance your decision-making process. For example, during an expansion, as we were discussing, there's this general sense of optimism, right? Things are looking up. This is often a good time to maybe consider investments that are geared towards growth.
So like stocks in companies that are expanding, innovating, maybe taking on a bit more risk, that kind of thing.
Exactly. Growth stocks, as they're often called, they tend to perform well during these expansionary periods because, well, investors are just more willing to take on a bit more risk in pursuit of those higher returns. Real estate, too, can be a really attractive option during these phases as property values tend to rise along with that overall economy.
So kind of like riding that wave of economic expansion, right?
Yeah.
But what about when the music starts to stop, when we approach that peak we were talking about? How should investors be adjusting their sales, so to speak?
As the economy, starts to heat up, we get closer to that peak, it's often prudent to become a bit more defensive with your investment strategy. This might mean shifting, maybe shifting some of your portfolio towards more stable, more well-established companies. Often these are referred to as blue chip stocks. These are companies with, a long track record of profitability, they pay dividends, and, they tend to be a little less volatile than than those growth-oriented counterparts.
So a bit of a safety net as the economic winds maybe start to shift a little bit. And what about bonds? We talked about their appeal during like a contraction, but how do they factor into an investment strategy, say, near the peak of the cycle?
That's a great question. Near the peak, you often see interest rates on the rise. Central banks are trying to get a handle on inflation, keep things from overheating. And this can make bonds, well, a little less attractive because as interest rates rise, the value of those existing bonds, it tends to fall. However, and this is important, not all bonds are created equal.
So it's not just like a one-size-fits-all approach with bonds. There are nuances there.
Absolutely. There are many different types of bonds, each with their own, risk and return profile. Near the peak, you might consider, say, shorter term bonds, which tend to be less sensitive to those interest rate fluctuations, or you might look at inflation protected bonds, which are, as the name suggests, designed to preserve your purchasing power as prices rise.
So even within a particular asset class, like we're talking about with bonds, there are ways to fine-tune your approach, really based on what's happening in the economy at that time.
Exactly. And again, it highlights why understanding these cycles, these broader economic forces, is so crucial. Now, as we move into a contraction, that's when things get really interesting, especially for investors who have done their homework, so to speak, and are ready to act.
Okay, so let's talk about navigating a contraction then. We've already touched on, the potential of stocks being undervalued during this phase. Anything else investors should be, keeping in mind, considering as they're looking at their portfolios?
Yeah, during a contraction, especially if it's, a particularly deep one, you might see opportunities in what we call alternative asset classes.
Like what?
Give
Give
it
us some examples.
Well, real estate. Real estate often presents these unique opportunities during contractions. Property values might decline, but that can create some really compelling opportunities for those with a longer term and investment horizon. And, remember earlier how we talked about gold being that kind of safe haven asset? Well, that still holds true during a contraction.
So when the markets are feeling, maybe a little bit shaky, a little bit uncertain, gold can be that way to like add a little bit of stability back in your portfolio. This has been such an eye-opening look at how these economic cycles, they really do impact, well, everything when it comes to investment strategies.
It really is all about understanding that interplay, that connection between the economy and the markets. And, we've been kind of hinting at it throughout this whole discussion, but I think it's worth really emphasizing that trough phase. When things seem their bleakest, that's often when some of the most compelling opportunities they emerge.
Because sentiment is like at its lowest point then, right? Well, not everyone, but it feels like, the I guess the mood, the overall feeling surrounding the market, it's not good. But for those who've done their homework, for those who are ready to kind of, I guess, step up and act, that can be a chance to really, potentially buy low, like they say.
Exactly. And this is where, having that long-term perspective, it is absolutely essential because yeah, during the trough, you're essentially buying into markets that are, they're still depravity. They're still working their way through things. But if you've done your due diligence, if you've identified those fundamentally sound investments, well, those positions are, they're really well positioned to benefit from that eventual recovery.
So patience,
Yeah.
and maybe even a little bit of, well, I don't want to say courage, but it takes a certain mindset to kind of to push through that fear and really, stick to your strategy when things look their worst.
It does. It takes discipline for sure. We've covered a lot of ground today, really kind of delving into each of those phases of the economic cycle, talking about, how it can influence those investment decisions, what to be looking out for.
As we kind of wrap up here, are there any like key takeaways, anything you really want to leave our listeners with today? Any final, I guess, words of wisdom?
I think, if there's one thing I hope folks take away from this whole conversation, it's that the economic cycle, it is just that. It's a cycle, it's continuous, it keeps moving. Each phase, it has its own opportunities, its own challenges. And I think just having that awareness, being able to kind of step back and say, okay, where are we in this cycle? What are the historical trends? What are some of the things I should be thinking about, watching out for given this particular phase? That can make a world of difference.
So knowledge is power,
Yeah.
as they say, especially when it comes to, to navigating these often choppy waters of the economy, of investing.
Couldn't agree more. And, I always like to remind people, investing, it's not about trying to time the market perfectly. That's incredibly difficult. I don't care who you are, how much experience you have. It's more about understanding those forces that are at play, managing your risk and just making sure your portfolio is, it's well positioned to kind of weather any storm.
Well said. This has been incredible. I know I've learned a ton today. I'm sure our listeners have too. Thank you so much for joining me today, for sharing, well, all of your expertise with us.
Oh, it's been my pleasure. I'm always happy to talk about this stuff, so anytime.
And to our listeners, remember that economic cycle, it's always in motion. But by taking the time to understand its rhythm, to understand those patterns, you can be one step ahead. You can start making those decisions that really align with your financial goals, with what you're trying to accomplish.
Sure.
So until next time, everyone, keep learning, keep exploring, and happy investing.